All right.
All right. Hi, everyone. Thank you so much for joining us today. I'm Anna Marie Tasofis. I'm from FinStrat Management and really excited to have you today for today's session. Before we dive in, love to invite you to follow us on LinkedIn at Novel Capital and FinStrat Management. We'd also encourage you to share any questions that come up during the conversation in the Q&A box at the bottom of your screen. We'll be reviewing them towards the end of the session, but please don't hesitate to send them in as we go. Today, I have the pleasure of being joined by our two hosts, Kristian and Carlos. Kristian Marquez, founder and CEO of FinStrat Management, and Carlos Antequera, co-founder and CEO of Novel Capital. Kristian and Carlos, thank you so much for being here today. Before we jump in, I'll hand the floor over to them to further introduce themselves and get started.
Thank you, Anna Marita. Happy to kick things off. Carlos, great to see you. I think also last time when we were together, we were at Venture Atlanta.
Yeah,
Uh,
not too long ago.
yeah, this is
It
great.
seems like long ago now.
Oh my gosh, yeah, time flies. Well, thank you everyone for joining us today. As Anna Marita mentioned, my name is Kristian Marquez, founder and CEO of FinStrat Management. Really excited to talk about capital fundraising, preparation, and insights. In my role, I oversee the professional services and venture capital management for FinStrat. Today, effectively, we work with over 50 investor-backed tech companies, vertical agnostic, and happy to share our perspective. In over 9 years, we do keep track. We've assisted our clients close on over $500 million in financing. So notes, price equity rounds, debt facilities, and acquisitions.
Great. Thanks, Christian, and great to share the meeting with you today. Good to connect with everybody. My name is Carlos Antequera, CEO, co-founder of Novel Capital. We started Novel about 5 years ago. My background is really as an operator. This is my second venture. The first venture grew it, and over 14 years, HR software platform sold to Vista Private Equity. So I have experience building a tech company, raising capital, the challenges of that process and managing that process. And now at Novel Capital, we work with over 160 companies. We provided about 180 million to those companies to help their growth and accomplish their mission. And super excited to share some of those learnings and answer any questions about how do we see the market and how do we help founders accomplish those goals.
Yeah, and just additional color. I mean, really excited everyone to join us. FinStrat and Novel have had a relationship for the last couple of years. They've extended debt financing to a number of our clients, so we've had the opportunity to work closely with them and know that they're a professional organization who take customer service and due diligence seriously. So I think everyone is in for a treat. With that, so we can drive into it. So we're gonna start with, like all things, proper prior planning. Like what are the things that we should think about before we get into the process of a raise? So happy to kick things off. And I think the big thing here that I would encourage everyone to start with is mentality. If you think about financing, whether you're raising equity or debt, you're going to go to an investor. And that investor may be deploying their own capital, they may be deploying capital from their investors. And understanding that this is the case is really valuable because they're looking for a return. It's not just about making sure that you can take advantage of your own market opportunities, but appreciating the fact that they're looking to generate returns for what are otherwise known as LPs, limited partners, in their own funds. And so, just starting with that mindset, I think is really valuable because it immediately brings a degree of maturity to any conversations that you're in when you appreciate that they're not doing due diligence to make your life difficult. Is they're simply executing on their fiduciary responsibility to do well to their own investors. And so with that, if there's a starting point, I think the next natural question is like, all right, well, what are the things that need to take place in order to satisfy either an equity or debt lender's due diligence requirements. And at the end of the day, you can distill much of this conversation to risk and reward. It's like what's the profile of your business? Can you adequately communicate that? And we'll talk about the means by which you can do that. But then also what's your upside? Um, but I think one of the big pieces of encouragement I'd give anybody in this process is yes, most founders by definition are optimistic. Now, it's one of the reasons why you're bringing solutions to market, but you also want to be realistic because you're basically telegraphing to anyone who may give you capital that you have a solid handle on the world around you. And we'll talk a little bit more about what that looks like as well. Carlos, to you.
Yeah, so when we meet founders, not only that connect with Novel, but just across the spectrum, I think there are three things that I advise them to think about around their capital strategy and how they think about their fundraising. One is what is your long-term vision or journey? Because each fundraising is not separate from your overall capital strategy. What you decide to do today is going to affect what you are going to do on your next round or the next round of capital that you're going to need. So you need to think about it holistically and decide what your journey is, what your race is, because it's your own, right? So you don't have to always do venture. There's no instrument that is good or bad in itself, but you have to see what is the right instrument for you at the right time, and understanding that long-term play and long-term journey really makes a difference. Second, I think is really think about what is the milestone that you're trying to accomplish today, right? So we ran across a lot of founders that say, hey, we're raising $3 million. And when we get to what is it really that they're trying to accomplish, they will tell you how they're going to spend the money, which is different from what is the real milestone you're trying to accomplish and what is the capital that you need to accomplish that milestone. Now, it might not be $3 million, right? It might be $1 million in the near term or less even, depending what you're trying to do. And third, I would say, understand based on where you are, what your real options are, so you don't waste your time, you don't bang your head against the wall. If you are not growing at a healthy pace, if you don't have certain things that VCs are looking for, if you understand those requirements, if you don't understand those requirements and you try to raise from VCs, it might not be the right match for you. And so you're going to waste a lot of time and get frustrated. So understand really what is the right instrument for where you're at today is going to help you a lot in being more efficient with your time when you're trying to build your business.
Carlos brings up a couple great discussion points as well. So it's worth unpacking, how you convey your outlook. And so we can talk data rooms. But the other thing too, and this comes up, I find myself in a lot of conversation with founders where they kind of bemoan the fact that they get ghosted by investors, or they have good conversations. The next thing they know, they go blank. Know that it's not personal. If you really start to look at a lot of like traditional just venture capital equity investor businesses, they're very analog. So despite all of the productivity gains that everyone's experiencing with artificial intelligence, a lot of that business is having conversations, and there's only so much time in the day. And so not an excuse for, not being treated, with responses or insights as to why they may not be passing, but just know that in part it is a numbers game. And, I don't know if it's the best analogy, but, the old, you got to kiss a lot of frogs. There's some truth in it. You just got to be persistent and determined. And so just know that if it feels like a slog, you're in good company. It's generally par for the course. All right. So with that, Carlos made mention about, conveying what your outlook looks like. And I just meant a moment ago mentioned a data room. So core to any fundraise, debt or equity, it's going to be having a set of collateral that you can share with any interested parties. That's going to go in your data room. your data room could be a Google Drive. There are third-party software companies out there that sell access to, data rooms. And they come with a whole host of features and functions that will enable you to see who accesses the data room, and in particular, what types of files that they hone in on. I don't know that there's any right or wrong answer in terms of how you make collateral, even if you email it. I think the more important is, what does that collateral consist of? And probably the two biggest piece of items are going to be your deck, and your deck is going to answer use of funds, like Carlos mentioned, but it also should include a financial model. And the financial model will most likely have your actuals. Show us how, what's your revenue been, how are you incurring expenses, what does your cash balance currently look like in your runway, and then your forecast. All right, so actually give us a sense of what you anticipate taking place. And to Carlos's point is, when we do get, if and when we do give you capital, how does that impact your growth trajectory? Carlos, I don't know if you want to build on that.
Yeah, there are a couple of points there that you highlighted, Kristian, that are critical, and again, kind of in our experience, we see many entrepreneurs that maybe are good at telling their story, good at building a good pitch deck, but they haven't done the work on their financials. They haven't worked with professionals. They haven't prepared themselves. In our particular case, being a non-dilutive capital provider, we are really depending on those financials being accurate, having a good forecast that is reasonable and believable. And a lot of founders that we talk to come unprepared for that process, and they make their process more challenging, right? So if in our case, one of the first things we're going to get is access to your financials, access to your banking information. We're going to ask some questions that are related to your forecast. If you don't have those answers ready, or you have to go back and work at that point into building your forecast, at that point into updating your financials, then that just delays the whole process. So as you go to hit the market, as you're going to talk to capital providers, just know that those things are going to come up. Maybe not in the first conversation sometimes, but they're going to come up. And the more ready you are for those things, the faster the process is going to be able to move when you have that good match for a possible capital partner. So it's just be prepared. That's going to be needed.
Yeah, and if you think about I'm sure everyone's attending this call to increase the odds that they can get financing when you do kick off the process, if you're not already in it. But there's some other points to what Carlos just mentioned that I think are also worth shining a light in. Is, today in the States, I mean, there's over 1,000 VCs, let alone angels, that you can pursue, and then dozens of lenders. One of the things that I'd also encourage you to appreciate is, they all have different theses, investment theses. Some of them will tell their own investors, like, hey, I'm not swinging for the fences. I'm looking for 1x, 2x, so think singles and doubles. Or, who are investing in very specific niches. And if on the surface you're like, okay, well, no doubt, Kristian, that makes a lot of sense. I can't tell you how many times I've seen founders waste time thinking that, yeah, sure, it's a numbers game. Let me cast a really wide net. But you do yourself a favor if you can really appreciate who you're talking to before you start the conversation. Because in effect, you're doing your homework. You're conveying to them that you respect their time and their business. And in my experience, that just increases the odds that you'll at least get through the next gate and one step closer to a financing.
Yep, I would add to what Kristian said, right? Do your homework. Again, that's going to save you time. I'll give an example for us in particular. We try to be very transparent with what our requirements are, right? You need to be a US-based company. You need to have at least $500,000 in your trailing 12 months revenue, and you need to be a software or tech-enabled company. So if you meet those criteria, the odds that we will be able to partner are very high. On the other hand, we will get sometimes folks that are outside of that. Somebody comes to us with 300,000 in revenue. Unfortunately, right, we won't be able to work with them. If somebody comes and they're in an e-commerce or something that is outside of our scope, or if it's some company that is based outside of the US, we won't be able to work with you. So as Kristian said, understand who you are talking to, understand what the parameters that they look for are, and that's going to save you a lot of time. Otherwise, you're basically, spray and pray tactic that doesn't work very well. And the more you're focused on understanding why that capital provider is going to be a good match to you, the better your odds are.
Yeah, 100% agreed. If I can shed some light on just some more pro tips. At this point, I presume everyone who's participating in the webinar today has, either a ChatGPT or Claude or Gemini account. If you haven't already, it's a phenomenal tool. Just input, put your company website in, or provide an overview, and then say, hey, help me find investors who will invest in companies like mine. Not only will it give you a list, but you can turn that into a table. You can get names, you can get emails. And another question I always get is, should I just cold email people? Should I reach out on the LinkedIn? Should I insist on a referral? All of the above. If you ever feel like raising capital is a full-time job, you're in great company. It is going to take up a lot of your time, and it's normal to say, well, how am I supposed to do this and run my company at the same time? This is why the expression, if it was easy, everyone would be doing it, comes from. But I absolutely encourage you to take advantage of large language models today, because it will save a tremendous amount of time in ensuring that you can get targeted with your outreach.
Yep.
A couple other thoughts. I think it's worth calling out. So, Carlos, you also mentioned actuals and forecasts. I think yes, actuals are a very objective point of data. Your cash balance is your cash balance. But I also think you need to appreciate whether it's a debt or equity lender. Once you do receive investment, they're going to have reporting requirements. Typically, it's quarterly. Sometimes it could be monthly. But accuracy is the name of the game here. Again, I'd ask you to please appreciate that anyone who's giving you money has someone to answer themselves. And so, reporting requirements are generally baked into term sheets and investor docs for a good reason. They need to understand what's happening with the companies that they're investing in. And on the subject of forecasts, yes, it is subjective. If there was a pro tip of the day, in my experience, most investment analysis is going to hone in on two things in particular, though we can talk about a whole host of metrics. It's going to be what's your top line growth, and it's going to be what's your bottom line. Are you losing money, or you break even, or are you in the black? As it relates to top line, I can't tell you how many times when I've asked to see a company's pipeline out of their CRM, it's almost non-existent. If there was a set of tasks that you devoted time and energy to, your CRM and your pipeline are just central. Because if you think about building a forecast, yes, you can do a top down, use average growth rates, expansion rates, churn rates. But a semi-sophisticated investor is going to actually ask you, well, how many people are you actually talking to? What are the size of those deals? When do you anticipate them closing, and what's the probability? And that's really how you should be building a forecast for purposes of raising, because you should anticipate getting asked. And if you want to maintain, credibility with whomever you're talking to, it is a degree of sophistication that you should bring to the table. Carlos, I'm curious your perspective.
Yeah, you really hit it on the nail. I think from our perspective, there in terms of financials and data that are central to our analysis, we're going to be looking at your profit and loss statement, right? We want to make sure that that's current, that those numbers are accurate on the actuals. We're going to be looking at your balance sheet. We're going to be looking at your forecast, right? And we want to make sure that that forecast is centered on your historical actual numbers. That there's an anchoring to some reality there, especially the near term forecast. But another critical element is having not only a CRM that is current, that is well kept, but also from that pipeline, we can get a sense of what is your velocity, right? What is the likelihood of other contracts that are coming in and revenue that will be coming in. So understanding not only that you need to have a clean CRM, but understanding your metrics, right? So what is your sales cycle? What is the average size of your deals? And then being able to show, in our particular case, right? We work with companies that are post-revenue. We want to see that there is some confidence around the unit economics, right? That you know that every salesperson that you have, or whatever your go-to-market mechanism, there is a cadence and a repeatability to it. That it's not just you get a random customer or contract every so often, but there's really no way to predict that. So for us, that predictability, that consistency is very important.
And Carlos is 100% correct. I'll give a little bit more color to help bring the point home. So, if you look historically how long it's taken for a company selling software to get to 100 million ARR, for the longest time, I mean, it was a decade. It took HubSpot 10 years. Today, companies are doing it in not only a fraction of the time, but a fifth or a sixth of the time. And it really just kind of speaks to the fact that if we start taking a look at what are the types of companies that are raising the most capital, shocker, the focus today is on artificial intelligence. But in some cases, yes, it's the technology for the technology's sake, but it's also because founders are now in a position to iterate faster and by consequence find product market fit more quickly. And so, there's an old expression, we like to use: if there is doubt, there is no doubt. And, no, I'm not suggesting don't ask an advisor, by all means do. But, you'll know if your growth percentages, and I would tell you in this case, it's, depending what your starting point is, 5% month over month at a minimum. Put you in a position today to be able to increase the odds that you're going to raise capital. Because again, it just comes back to deleveraging risk. And having a clean pipeline is going to put you in a strong position to at least, confidently answer for yourself and or investors of how you're standing.
And understanding, depending of what stage your company is at, if you are raising a pre-seed round or a seed round or an A round, understand where those expectations are for investors, right? So as Kristian mentioned, over the last probably 12 months, 6 months in particular, with the advent of the efficiencies of AI, a lot of companies can scale much faster. And so a lot of the equity investors in particular, expectations of growth and revenue have moved up. Before, what was acceptable probably to do a Series A, a couple of $1 million in ARR, $2-3 million in ARR would put you in a very good position. Based on the metrics that a lot of VCs are using now, that bar has moved, right? They're expecting now 5-7 million in ARR, and in a much shorter periods. Like Kristian mentioned, what before took a company sometimes 10 years, now some companies are doing that in 3 years. Mm-hmm. So or even less in some cases. So understand those expectations. If you are trying to raise an A round and you have $1 million in ARR, it's probably not going to happen unless you're a very, very unique situation. Obviously, there's edge cases, but in most cases, the expectations have moved up, and the same for a seed round. What was acceptable before 12, 18 months ago for a seed round, now the expectations are much higher in terms of revenue, in terms of growth. So that should also let you plan better, right? If you were forecasting that you were going to raise your next round in the next 3 months, and your metrics are not there, you might need to rethink really your capital options and also how you run your company, and maybe decrease your burn if you're burning a lot. So really keep those the realities of the market as well as your desire for capital.
Agreed. And Carlos, if you want to build on that, would love to hear what some of the financial metrics that Novel looks at when making a decision of whether or not to fund a company.
Yeah, definitely. Again, we are a debt provider for early stage tech. So we're going to look at things a little bit different than a VC, right? So when a traditional VC is going to be looking for 100% year growth year over year, for example, we are still looking at growth, but I would call it kind of much more reasonable expectations. So we're looking at probably 20, 30% year over year growth. So growth is important to us. Your runway is very important as well. We are looking generally at companies that have 6 months of runway, because we are providing an amount of capital that is, if you are burning too much, is probably not going to help you. If you're burning $200K a month, and I give you $500,000 in 2 months, you will be in the same situation. So that is very important to us as well. And then gross profit margin is the other key element that we look at. Right? We want to make sure that if you are putting money in the company, you are going to be able to generate enough margin to be able to grow and be able to service the loan. So those are probably the 3 key elements that we look at.
Very helpful, and I guess one of the things I'll add with my CFO hat on, because I find I'll build on this, and there's some metrics, and I also think it's valuable to call out like percentages. So gross margin, agreed, really important. Historically on SaaS, it's going to be 70 to 80%. But AI is definitely changing things. Making sure that you have a great handle on your compute is really important. And if you find yourself running gross margins that are like, materially less than 70, I hate to say you're in good company, but you are. Now, is that, from where I sit, I still kind of get the feeling, though, that the market is kind of better understand what expectations should be. I think really at the end of the day, there's no escaping it. I mean, Cursor was running negative gross margins for a few years there, and they've had a tremendous amount of success. But you just please appreciate, it is still a bellwether. I still think there's a psyche attached to it. And someone, can simply just think, oh, you're offering software, you should have great gross margins. And so I don't know that there's a great answer per se, but I think at least be prepared to explain why you would have lower gross margins if you were under 70%. Some of the other ones we get asked about, so Carlos mentioned growth. I'll throw out, so customer acquisition payback period. Really valuable, a little bit in the weeds. Basically, it's answering the question, how much money are you spending to acquire a client, and then how long does it take for you to recoup that expense in months? Usually a benchmark has been 12 months. Over that, you're going to run into cash issues, because it's basically saying either you're spending too much on sales, you're not charging enough to put yourself in a position where you don't have cash flow issues. So closer to zero is better. And then we could unpack that as well. But that's a big metric. And another big metric that I find that comes up in a lot of investor conversation is return on customer acquisition cost. So it's just an ROI metric. It's looking at how much you spend to acquire a customer relative to their lifetime value. And, at a floor, you can say generally most investors will say for every dollar you spend to acquire a client, we want to see you generate at least 3. in value. But arguably sky's the limit. So, if you were to use a range of 6 to 3, somewhere in there, and you're in between, great. Now, is it to say that, hey, I got an ROI of 10 to 1 or 100 to 1? No, but I think that's where you start having a tremendous amount of value in engaging a chief financial officer, because they can help you appreciate that you may be leaving money on the table. Said another way is, it is an opportunity to start dissecting metrics to better understand how the business is performing and what the market is yielding. Carlos, any other metrics top of mind for you?
Th- those are probably the key ones that we talk. But as you were mentioning, some of those other metrics, I go back to understanding again where what your capital options are, who you're talking to, right? VCs, equity investors that have a longer term view are going to be looking at some different metrics because they're trying to figure out your capability to scale this over time, and be able to take chunks of market share. So you need to be able to do it efficiently. You need to be able to get to a point in which dollars that are getting invested are really growing profitably, right? In our case, although those metrics are important for us, those are probably sub metrics because we're looking at a shorter timeline. Our instrument is a 2-year instrument, so that is kind of the area, the timeline that we're trying to really understand, versus a VC investor that's probably looking closer to a 5 to 10-year horizon, right? And so just understand again, not every capital provider is looking at precisely the same metrics, or even if they are looking at the same metrics, they don't necessarily have the same bars on those metrics that they're trying to optimize for.
Yeah, and actually a perfect segue. And the next question we regularly get is it debt, equity, or both? And help me understand. So why don't we, if I may, I'll just do a quick framing, just so that we're all on the same page. So I presume everyone's aware, if you receive an equity investment, I'll oversimplify it, but in effect, you're selling a portion of your company. So that investor has ownership in your company. They're on what is known as your capitalization or cap table. And until which time they no longer own their shares, you're proverbially in bed with them. Debt, you've heard Carlos mention non-dilutive. They don't, again, depending on the lender, but we'll keep it simple. They're not on your cap table, but you do have a fiduciary responsibility to pay them back by accepting their capital plus interest. Is there a scenario, and is there a scenario where you can do both? Absolutely. We have a lot of clients who will close a round of equity financing, and at the same time, we'll put a debt facility in place. Now, it brings us to the next question, and that's, well, why? Why debt versus equity or both? So the way I'd encourage everyone to think about it, and let me start with an analogy I think everyone should understand. So, if anyone on this call owns a home, odds are you have a mortgage. And depending on when you bought your home, it'll dictate what the interest rate is on the house. So pre-pandemic, mortgage rates, don't quote me, but let's say somewhere between 4 to 5%. Today they're 7. So the cost of capital has increased during that time because the Federal Reserve has raised rates. And I'm not saying one is good or bad. I'm just saying is that the cost of capital has increased. And so it really brings up a question. It's like, all right, well, if I'm going to bring on debt, why would I bring on debt relative to how much I have to pay back? Well, it really comes down to returns. If we were looking at your financial metrics and we can see that you are generating, making this up to, I'm going to exaggerate to make my point, 100 to 1 on what you were spending to acquire a business, you could cost justify, a higher interest rate because you're in effect, generating a return to not only cover your expense, but make a profit. And so interestingly enough, I find a lot of people don't realize this, but did you know that Microsoft Apple, Meta, they all issue bonds in the marketplace. They have billions of dollars of cash on their balance sheets already, yet they still realize their businesses are performing so well that they can leverage their capital even better by taking on that debt, and by consequence, not further diluting their investors. So, lenders like Novel become very valuable to founders, because not only can you get a greater return, but at the same time, you can maintain more ownership of your company. Carlos, I love your perspective.
Yeah, the way we try to educate founders or help them to think about it is at the beginning of your company, especially with a tech company in which you have R&D risk, or you have to really get some capital to get to that product market fit, and then to really have unit economics that you have confidence around. You might need equity, right, to get to that point. But once you get to that point, which is the riskiest point, if you will, of the company, and for that capital, when you get equity, the expectations of VCs and other equity investors are going to be 10 to 1, 20 to 1 on that dollar that they give you, right? So they have high expectations on that. So that is kind of what you're paying. If you are successful with your venture at the end of an exit, that is the returns that those folks are going to be expecting. So once you move once you move your company up in the maturity level and you have de-risked a lot of those elements, one of the ways to think about it is, yeah, you could go get more equity and you will have to pay that return of that 10x, 20x that they're expecting. Or, as Kristian was saying, if you want to optimize the value that you are creating, what we tell founders is, if somebody gives you $1 and you have confidence around your unit economics that you can generate $3, $4, $5, you would give me 20 cents all day long, right? And so now, if you don't have the confidence around your unit economics yet to that level, maybe there's some more work you need to do in the business, and that's fine. So that is an easy way to think about it. I think about kind of what is it, when can you optimize for your capital stack, and when does it make sense to get that debt or equity. The other thing I think that's important to think is not all debt is equal, right? So we have a lot of conversations with founders that are their analogy of the cost of capital might be what they see for a mortgage or for a car loan, right? In which there is a liquid collateral, like your house is the collateral when you get a mortgage, right? So when you are getting debt for your company, especially at the earliest stages when you are not profitable, and unless you have buildings or machinery that the company owns, that could be the collateral for which there's a liquid market, then the cost of the loan, of the debt, is going to be more expensive than what you're used to seeing on those consumer type of loans, right? Because there's a different level of risk. And as Kristian mentioned, when you get venture debt, which is one type of debt, right, there is in some cases warrants, which have the opportunity to convert to equity at a later stage. So there is an additional cost besides the APR that you see, and you have to take that into account. So really, without getting into the weeds, just understand that there are a lot of flavors of debt, and the cost is simply associated to the risk, right? If somebody maybe has a lower APR, but they're going to require a personal guarantee of you besides the business guaranteeing the loan, then there's a certain cost. If there is no personal guarantee and therefore no risk on you personally, then the cost will be different. If there are warrants, the cost will be different. So just be aware that there are multiple levers and multiple flavors of debt, and just understand that when you're comparing those things, sometimes it's not apples to apples.
That's right. And if your head's spinning, all good. You're not the first founder. As you get to the point where lenders like Novel Capital are going to engage you because your business is matured so that you can take on financing, I absolutely encourage you to have advisors, whether it's a chief financial officer or a lawyer who can evaluate a term sheet. That's par for the course. I think these macro concepts are great, and I commend you for joining us here, so you have a framework. But if it feels a bit overwhelming, totally normal. There's obviously a lot to unpack, and then there's just the context and experience of what are good covenants, what's a good liquidation preference, what are the terms that I'm being asked for in order to accept this capital. And I'll tell you personally, most investors I've run into, I mean, they're just, they're good people. Is it to say that there aren't the occasional nefarious person in there? I've seen it. I can think of a client who hired us a long time ago, and they had put some convertible notes in place with some angel investors, and they totally took advantage of her. She didn't know better. And when she finally sold her company, she did great. But the size of the returns that these angel investors got relative to the risk they were taking, they totally took advantage of her. So again, that doesn't happen as often. Unfortunately, there's reputable investors out there like Novel, and I again love working with them. I know our clients' experience has been great, but I definitely encourage you to surround yourself with advisors to give you their take on any terms that you're presented.
Yeah, and as Kristian said, right, the folks that we work with that have either a full-time CFO or even a fractional CFO, or in the case that they are not able to have that in-house, have advisors that can support them in just really understanding and thinking through their capital strategy, tend to be more prepared to have those conversations, and tend to also move faster to that process, which, being an operator, and as Kristian mentioned at the beginning of the call, it's a time-consuming process to raise capital. And when you're trying to run a business and build that business, which is the main part of your job, you want to get through that fundraising or through getting the capital process as efficiently as possible, so you can really focus on building the business. And that's ultimately what we try to advise founders and help them move through that process.
Agreed. Great segue too into what are some common pitfalls, or at least what does success look like? Maybe we'll frame it in the positive. Um, I imagine that a lot of people, maybe in their morning inbox, see press releases about this or that company raising tens of millions of dollars. And I'd encourage you not to beat yourself up over it if you feel like you're behind the curve, because the part that you don't see in that article are the multiple quarters, not months, that they most likely spent getting to that point. All right, so now I think at this point we've done a great job of just talking about what are your expectations. How do you optimize looking for investors? What's some of the collateral? But are there any other pro tips to increase the odds that this results in a successful outcome? I think the answer is yes. So timing, if you don't, if plan ahead. You heard Carlos mention, one of the metrics they'll look at is your cash runway. If you wait till you're down to your last month, for sake of example, you shouldn't be surprised if someone says no, or you know, uh, throws some very investor-friendly terms in front of you because they know you need their capital. So, just thinking out multiple quarters ahead, I think is really valuable. We talked about the integrity of your data room and ensuring everything is buttoned up, very valuable. It conveys sophistication and seriousness to take their capital. Um, you heard me make a comment earlier about kissing a lot of frogs. It's true. Just mentally prepare yourself that you're going to have a lot of conversations. There's going to be rejection. It's not personal. You just got to find that investment committee or that investor whose thesis matches what the company that you're building. Carlos, any other thoughts on like pitfalls or what success looks like?
Yeah, I think one of the things that you mentioned, even at the beginning, is a great thing to remind folks. One is plan ahead and plan with time, right? In most cases, because founders, as you mentioned, are overly optimistic, um, you tend to think, hey, this is going to happen in the next month, 2 months, 3 months. And on average, again, not that there are not exceptions, most fundraise processes are going to be 6 months to 12 months. And so just be aware that it's going to take that amount of time to be successful, and be prepared to spend that time. The earlier you start with even just building relationships with folks, understanding what the requirements are, even before you have that capital need, the better off you are. That's the other thing that we see some folks that are too close to the capital need. Either they're running out of money or they're trying to execute on a strategy that is in the next few weeks. And so therefore their options get limited, and things get complicated. So start, I would say, ahead of time. And like we said earlier, really understand your audience. Be really aware of what type of funder you are talking to, and what is the best type of funder for you given the stage of the company you are. And something that we even internally talk at Novel, be intellectually honest, right? So if you're not if you're not at a super high growth moment of your company, just know that venture equity is probably not going to be in the cards for you at this point in time. It doesn't mean that you don't get there later. Just be realistic with where you're at, and what your true options are.
Yeah, there's something, I agree on all points. I think there's something else we really haven't spoken about. And I appreciate that this is a webinar around, financing, but bootstrapping is also totally acceptable, either for the life of the business or, as Carlos points out, and to a point where you can justify or create venture level returns for your investors. Does it mean, you may be able to, you may have to take advantage of less opportunity? Yes. But, there's, in my experience, there's also a tremendous amount of lessons that come out of having to be very capital conscious. And my opinion is, I see this pattern when somebody gets, a big investment, all of a sudden they start spending money very quickly. And, if it's to plan, that's fine. But, at the same token, I've also seen companies, despite counsel to the contrary, where, they get a big injection for $10 million, and 18 months later, it's like they're back to their starting point, and they go try to raise more capital and they can't. Because, appreciate that once you get that capital, the clock starts ticking. You absolutely have to either accept that, hey, this is the last round I'm doing, and so what I raise is going to set me up to propel this company forward, or you have to look forward to the next round. And there is absolutely this concept of an expiration. So you close it, for sake of example, you close a Series A. I mean, unless your business starts firing in all cylinders in a material way, the expectation is that in 18 months, you're closing a Series B. And that investor who participated in the A absolutely wants you to see it close a B. Why? Because it means their investment's increasing in value. Obviously a little bit different flavor when it's debt versus equity, but I think it's really important to appreciate that there is an expectation that you're gonna execute with the money you get. Carlos, I'm curious your thoughts.
Yeah, I think you summed it up well, and I think we only have a few minutes left on the call, so it'd be great to hear from some of the folks on the call and answer some of the questions I think that have been coming through.
Great. With that, Anna Marita, it looks like we got some questions. If you want to read them out, and we can get them answered.
Yeah, thank you so much for sharing all those insights, Kristian and Carlos. And everyone else, feel free to keep dropping questions in the chat in the last 10 minutes. The first question I got that came through is, how does customer concentration play into your decisions when financing a company?
In in our particular case, that is one of the areas that we look at. As you may imagine, if a company, let's say, is has $1 million in revenue and they have two large customers, right? Let's say they're Fortune 500 companies that have big contracts. If you are at an earlier stage and let's say those contracts haven't renewed multiple years because you're relatively young at an earlier stage, there's the risk that some of those companies might not renew their contract, right? And so that poses a risk to us. So in our particular case, to give you more insights, we like to have companies that have at least 10 customers that make up their revenue, and that no one particular company is a large part, let's say, 50% of that revenue, for example. So it's an area that we look at. So we don't expect you to have necessarily, hundreds of customers, but if you have one or two customers that make up all your revenue, then that's a challenge for us.
And I'll just add with my CFO hat on. From Carlos's perspective as a lender, I agree 100%. If you're wondering, well, hey, if I have one or two or three customers that make up the most of my revenue, do I have an issue? No, it's just that appreciate you may not be raising capital from somebody. Said another way, great that you have customers who are going to pay you a lot. Go get more. And not to sound trite, but it's true. I mean, there's a starting point for every business, and usually it involves an anchor client. So know that from like a revenue profile perspective, it's normal.
And to the point, Kristian reminded me to the point he made earlier about CRM and pipelines, right? So that's where also that helps tell the story. If you have 2-3 customers and you understand that your sales cycle is 90 days and you have a healthy pipeline, you know that over the next, call it 3 to 6 months, that number is going to grow. In the other hand, if you don't have a pipeline or your sales cycle is 2 years, that's a different equation, right? And so understanding really your pipeline, your sales cycle, your sales motion, and your customer contract size, all those things really are super helpful.
Great. The next question that just came through is the pre-seed, seed, and Series A definitions changed? It seems like seed is the new pre-seed, Series A is the new seed on how investors look to invest, especially in the US.
Yeah, I think again there are exceptions, but in particular at this time, right, and the investment market goes through cycles. With the advent of AI, that's definitely where the bar has moved. How long is it gonna be at that stage? Is this a kind of the new bar and forever? That is hard to tell, but I would say for the near future, those are the expectations that VCs have. And if you are not an AI company and you don't have those revenue milestones hit, it's just challenging because, as Kristian mentioned earlier as well, everybody has a boss, right? So they have LPs that they have to produce returns. And guess what? If you as a VC are not investing in those companies or that have those milestones and have hit those targets, then they're not going to look favorably on you to raise your next fund.
I think it's a great question. I'll give it another way to think about it. To me, it's less important as the name that we assign to the round as it is how much money you get. So we really haven't spoke about, and we can probably devote an entire episode to valuations. But I'll oversimplify it and say this is that, generally speaking, from an equity perspective, if you're going to sell equity, you're doing somewhere, between 10 and 20%, let's say, or 30%, let's say on average it's 20. And so whatever dollar amount you raise is subsequently going to dictate the ending value of your company. Again, I'm oversimplifying this. That valuation has to be supported by revenue. Yes, there's some exceptions, like, if you're Elon or, some other big name founder who's starting a company and you can raise $1 billion pre-revenue, hey, high five. But the thing you should continue to keep in mind, whether, you're at a $1 billion or a $20 million, you still got to go generate a return. So that means you have to increase the value of the company, i.e., you have to generate additional revenue to support that greater valuation. So more important, are you closing a pre-seed, a seed, or an A? It's how much dollars you raising, what's the subsequent valuation, and then what's your confidence that you can generate enough revenue to get you to the next big valuation, appreciating that those multiples also change over time. Last thing I'll throw out there, if anyone on the call isn't already a subscriber, Peter Walker over at Carta, had the pleasure of having Peter on our podcast, very knowledgeable, spends a lot of time doing research on Carta's financings that take place on the platform. I think it's not only equity, but I think there's debt in there as well. Absolutely encourage you to subscribe to his newsletter. He does a really great job of showing how those amounts change over time.
This next question is a bit of a long one. It's a situational one. I have a small business where we are primarily a reseller and SI software services company. We put our profits into building a product of our own and now have a few paying customers. Given that my company is a QSB, diluting my equity and bringing in money in my existing C Corp is advantageous to me. The other way is to separate the product into another entity and rise, but we will lose overall valuation in raising money in a new entity will require me to sell the services side of the business. Is there a way I can keep everything in the same business and raise capital? If yes, what is my best option? Say I'm looking to raise 3 million USD.
I absolutely have an opinion, but Carlos, to you.
Go ahead, Kristian. Yeah.
Oh, so I think it's actually, first off, congratulations on building the core services business. You know, we've been really, I've seen now a whole host of founders who start with a service business and then will pivot to product. Let me acknowledge, first off, obviously there's a totally different mentalities. You go from being a yes company to a no company. Like, here's my software. That said, I mean, talk about deleveraging risk. It's absolutely brilliant because think about what you're doing is now you're putting yourself in a position where you don't have to be at the mercy of week to week decisions around a product because of what you're, not having enough cash runway. So to answer your question, you know, should you keep the software product in there or spin it out? First and foremost, it depends on what your objectives are. That said, if you're forcing me to give you an answer, I'd say keep it in. I know plenty of companies whose revenue profile not only includes software, but services as well. I mean, great example. I mean, take a look at Apple's, public reporting. I mean, a significant portion of their investment is services. They're one of the obviously largest tech companies in the world. And so they're not mutually exclusive. If you can have services business that, actually supports the software or vice versa, I mean, absolutely. It'll increase the overall enterprise value of the company. And without more information, I tell you, it probably increase the odds that you'll get your financing faster.
Yeah, I would totally agree with you, Kristian. I think a lot of founders get caught around, especially conversations with VCs that are trying to optimize for the recurring, right? And they want to have the least number of bodies on the expense side and the most ARR, right? And so a lot of founders get caught around that, and so they think the services side is somehow detracting from the value. But I agree with you. I think especially if you can make that a competitive advantage because it keeps you close to the customer to understand what the challenges are and to better support your product, it really actually becomes a net positive compared to other competitors that just have a pure product, but then they have to partner with somebody to deliver the services around it. You mentioned Apple, like it or not, how you feel about Salesforce.com has built a great business around a lot of the revenue services, right? That's to support their product, and that makes the product stickier and more likely for their customers to succeed and gain value of it. So I generally I'm a fan of keeping it all together. Also keeping it simple.
Yep.
I'll read out one last question. So the SBA 7A loans are taken away as an option for green card holders who are immigrant entrepreneurs. What options are available to immigrant entrepreneurs to raise 2 to 3 million USD?
Ooh, that's a great question. And I don't know that I want to put Carlos you on the spot, but actually I'd have to go research the answer. I don't know.
I'm not super familiar with the SBA programs, and yeah, I don't know the answer of the top of my head. I know that there are a lot of founders from Latam, for example, that are raising money from the US, and normally, you have to set up an entity here and set up at a minimum your banking accounts. But other than that, it's going to be a very similar process of the fundraising process, but with an added challenge of a lot of VCs or a lot of investors, will only invest in founders that are in the US, and in many cases have to be citizens or have some requirements around that. So, but yeah, not super familiar with the market.
If you force me to say something intelligent, I'll make best efforts. Here, I guess this is more tangential, but this is where my thoughts go. There's so much to do with building your company, but I would absolutely set aside time to network because you should be thinking in terms of a long game. So we made reference about preparing quarters out to raise a financing. Even if you're not going to do debt or equity, my own personal experience, um, make time to meet as many other professionals as you can, many other family offices, high net worth individuals, executives at corporations. You will be amazed of how opportunity presents itself the more people you talk to. And so, my thoughts go there because, I mean, um, FinStrat, we have equity investors. They're all single family offices. And we were very fortunate to nurture those relationships. But is there anything saying that they couldn't write you a loan? A single family officer, high net worth individual write you a loan? Absolutely. A lot of business is done because not only of the business prospects, but also who's the founders. Do they have agency? And if you can find yourself in that position, arguably you do. And so obviously there's other criteria, but long way of saying tack. you know be hustle and have as many conversations as you can, and also ask. I know we're over time here. I'll wrap it up with a quick fun story of my own. A long time ago, I had co-founded a telemedicine company, and I was introduced to a money manager by a friend who owns a registered investment advisor. And his advice to me before the meeting was, now, whatever you do, don't leave the meeting without asking for an investment. I was like, really? I can do that? And so I did. And the gentleman who I presented to, stared at me from across the room, and he kind of looked at me and he goes, I'll invest $500,000. And I was like, wow, that's how it works. So a long way of saying hustle and ask.
Well, since we're a little bit over the hour, if there are no more questions, go ahead and wrap it up here. And I'll leave it to you, Kristian and Carlos, to give some ending notes.
No, just thanks for everybody that was able to attend, and Kristian enjoyed sharing the room with you. And any founders that have additional questions or want to reach out, my email is carlos@novelcapital.com. Feel free to shoot me a note. Be happy to help you any way we can, even if it's not through Novel. As Kristian mentioned, sometimes it's about that extra connection that gets you to where you want to be.
100% agreed. Thank you very much. You guys are busy. I appreciate you giving us an hour of your time this afternoon. I hope you thought this was worthwhile. If there are any other follow-up questions, I imagine this is going to get published on both of our company's websites. And if you take a look in the show notes, we'll make sure to publish both Carlos and my contact info.
Awesome. Thank you, guys.
Thanks.
Thank you.